Well, greetings everyone and welcome to the Argonaut monthly video covering August 2024 and the first few days of September. Well, it's been another fruity start to the month with European and US markets already down some 4% in the first week of September. And although August ended benignly, the volatility witnessed highlighted a fragility in financial markets in that they currently seem priced for an immaculate soft landing, leaving little room for error on the direction of corporate profits, the maintenance of global liquidity, and the delivery of interest rate relief. Now, the fund ended up very marginally for the month. For more details, please refer to our August monthly fact sheet. Now, China is again exporting deflation to the rest of the world with its mercantilist model. And as we noticed last month, there is now a reasonable possibility of a significant economic downturn as the US economy is now slowing. We have repositioned the funds accordingly. Now, the main event during August was the Jackson Hole Symposium on August the 23rd, when Jerome Powell finally told the market what it thinks it already knew, which is the Federal Reserve will at its next meeting on September the 18th deliver its first cut to the Fed funds rate since July 2019. Now, Fed fund futures are currently implying 100 basis points of cuts in the 3 meetings before year end, with 25 basis points expected in September. Now, it is perhaps Wall Street's most well-worn dogma that investors shouldn't fight the Fed and instead should be mega bullish on stocks when the Fed is cutting interest rates. Well, we have analyzed the previous 11 Fed cutting cycles since 1970. And as might be expected, over the course of the average cutting cycle lasting over 1,000 days or nearly 3 years, the average annualized return has been plus 16%, so don't fight the Fed. There is, however, a more mixed picture looking at equity returns in the immediate aftermath of the first cut, with an average return of just plus 1% in the first 3 months, or minus 1% excluding 1998, when Alan Greenspan famously overdid the stimulus, stoking the dot-com bubble. So don't fight the Fed over a cycle, but the beginning of the cycle is not always the sweet spot. It may call for caution if rate cuts are not enough to offset economic weakness and high valuations. Now, although US economic data points are currently often contradictory, not much is improving, whilst new home starts, auto sales, the subprime consumer, and their credit delinquencies are worsening. US recessions usually start with the low-end consumer running out of money. With the 3-month rolling average unemployment rate having risen 50 basis points from its low in less than 12 months. According to the Psalm rule theorists, which we now know has predicted every recession since 1970 in the US unemployment rate now points to an imminent recession. And surveys of businesses show that although they're not shedding workers, their hiring plans are very modest. Now, it is not of course certain that the Psalm rule will correctly predict the 12th recession, but it's certainly a data point which has got the market worried. Now, these first few months of the new cutting cycle will also see heightened political risk, with the US presidential election on November the 5th. We think this could be a negative for the economy as well as markets. Although mainstream media likes to focus on personalities, it is more useful for investors to study the differences in the economic agenda, both in terms of what the candidates are willing to say and also what they might do when they get into power. Now, Trump, ironically, is something of a known quantity, with an agenda to reduce the corporation tax from 21% to 15% for homegrown companies, and to fund this by raising tariffs on imports, 10 to 20% across the board, and 60% on Chinese goods. Now, this was standard Republican economic policy throughout the 19th century, where Tariffs paid for the government and taxes elsewhere were kept low. Harris, by contrast, remains something of an unknown quantity, having been parachuted in as a last-minute replacement, when after 4 years of vigorous service, President Biden was, following a poor presidential debate, suddenly discovered to be senile. Insofar as Harris has been willing to reveal her agenda, she promises to rescind Trump's 2018 tax cuts, with additional taxes for those earning more than $400,000, to raise the corporation tax rate from 21% to 28%, and increase capital gains from 20 to 28%, with a 25% minimum tax rate on all those with wealth above $100 million, including unrealized gains on investments. She's also proposed a doubling of the federal minimum wage, a quadrupling of taxes on share buybacks, a ban on fictional price gouging, and will expand antitrust enforcement. Now, whereas Trump supports cheap and reliable energy, Harris will extend renewable subsidies. Now, neither Trump nor Harris sought to appeal to the middle ground by appointing a more conciliatory vice president candidate. It would therefore appear understandable if major business decisions were postponed until the outcome of the election and a full agenda is known. Now, we've looked at returns in US presidential years, both in the Labor Day to the election day, i.e. from the beginning of September to the election day at the beginning of November, and then from the election day in November until inauguration, typically on the 20th of January. Now, excluding the excitement in 1984, anticipating the great Ronald Reagan's re-election in a landslide victory, S&P returns from Labor Day to election day since 1972 have on average been negative at -1%, which is an ill portent for the next few months. Now, whilst Harris ran unsuccessfully in the Democratic primaries, her views were considered to be more left-wing than President Biden. And we've recently seen in the UK that left-wing politicians can be uncannily silent on their real intentions until after they are elected. Now, what may be at stake in November's election is American exceptionalism, its trust in free market enterprise, and its distrust of big government. So-called democratic progressives want to make America more like Europe. Now, Europe has structurally stagnant GDP per capita or standards of living. That's not something anybody or any investor should find compelling. Moreover, given that Trump says he wants a weak currency, and both candidates will likely continue to run big deficits and perhaps borrow money to start a pointless sovereign wealth fund, whoever wins, the outlook for the US dollar is now much more uncertain. Now, we've previously outlined the geopolitical appeal of gold, with a reshaping of the global economy into two economic blocks, boosting the appeal of outside money, with gold with a market value of 15 trillion, the most liquid store of value. Now, geopolitical conflict is unlikely to go away, particularly if, as seen lightly, Harris is perceived as weak by America's enemies. Now, with interest rates falling and the greenback weakening, the appeal of gold has increased further. The fund currently has 12% of its NAV in blue chip gold miners, which, despite their ongoing popularity, currently on our quant screens not only trade very cheaply relative to their history, but are displaying the best positive earnings revisions in the stock market. Like George Bernard Shaw, we believe gold is the best hedge against politicians and government. You have to choose between trusting the natural ability of gold and the natural stability of the honesty and intelligence of the members of government. And with all due respect to those gentlemen, I advise you, as long as the capitalist system lasts, to vote for gold.